for this next person that we're introducing is someone that thinks outside of the box. And the cool part is that she's here to solve problems, and there's problems that we all, as business owners here, struggle with, or maybe not struggle with and need a little bit of help with, right? So our next speaker is gonna be Rose Taylor from the Redbud. Are you here? Okay, she's on her way up. As she's on her way up, I really want you guys to dive in because we're all learners, right? I see a lot of people taking notes. Are we all learners? Yes? Right? So we're taking notes. How about as she's presenting, we just write down a question. So at the end, we'll have something to ask. Are you ready to rock? All right, let's give her a big applause.
Thank you. Hello, everyone. It's so kind of ironic that they put me after Steven because we're going to bring you up and then we're going to bring you down. No, we're not. We're going to talk about the fun and exciting world of accounting and taxes, right? So a little bit about me. My name is Rose Taylor. I am an entrepreneur first and an accountant second. I graduated with a degree in business management. Do not have a degree in accounting. I got my start working in a accounting department of a fresh cut produce company, and I worked my way through every department, accounts payable, accounts receivable, up and up and up, and eventually to controller. We went into an IPO, we went public, and I was still feeling unfulfilled. You know, that's not my calling. I knew that I wanted to be in business, always. So I guess at that time, now I would have been an intrapreneur. What I know now, looking back, I would have been an intrapreneur. So I, did what anyone would do, and I quit my job. And I took out a second mortgage on my home. And I opened up a business on 240 and Penn. It was a retail store, and it was selling roller derby skates and gear. That was a hobby that I was very passionate about, and I traveled all over the country coaching for about 10 years. And you get into business, everyone says, oh, I'm gonna get into business to make money. No, you get into business to solve a problem. And that was a problem in our community. Locally, we couldn't buy products, and we couldn't try on products, and it wasn't quality stuff. So I opened up that shop on 240 and Penn, and I did that for probably about 3 years, and then again felt a need for something else. So I sold that business on installment and collect a check every month for that business. All during that time, I was still kind of doing some bookkeeping and accounting on the side because even though my degree is in business management, I have a knack for accounting. I understand it. I get it. I moved into taxes and eventually became an enrolled agent. If you don't know what an enrolled agent is, that means I'm authorized by the IRS to represent taxpayers at all levels of the IRS. So that's tax court, audits, appeals, things of that nature. I own an accounting firm, 2 of them, P3 Accounting and Redbud Advisors. My focus over the past 15 or so years has really been on real estate investors. I'm an investor myself, and entrepreneurs, because that's what I'm passionate about. If I consider myself an entrepreneur first, I really want to put put myself in my client's position. How would you think as an entrepreneur and not just an accountant? In the last 5 years, I got into cannabis, and that's the Redbud Advisors. And that's really been, there's a lot of nuances there, there's a lot of challenges, which is why I got into that. Again, seeing a need. Accountants don't want to touch something that's federally illegal, right? Or they don't understand how complex and complicated the Internal Revenue Code is for those types of businesses. So anyway, here I am. Yes, systems and procedures are great. I now spend the majority of my time working on the business, systems, policies, procedures, and cultivating my team. Because without a team, you don't have a foundation. Right now, we have a team of about 12 employees. So, yeah. And so today, I really want to talk about some tax type things, but I'm certainly open for questions and, comments. A lot of times, just like I mentioned, building your team foundation, your accounting is your foundation of your business. That starts with your legal entity structure. How is that set up? Is it set up to align with your long-term goals and your plan? A lot of times people come to me and they say, well, I'm paying too much taxes. Well, great, aren't we all? But it starts with good record keeping. So if you are the type of business owner that goes to your accountant at tax time and you bring them all your things and your income and your expenses and you say, okay, do my taxes, I'm paying too much taxes, you are already behind. You're acting reactively instead of proactively. So proactive is keeping your records, keeping your bookkeeping all ongoing basis, ongoing, because tax planning is something that takes place year-round and not at tax filing time. January through April, accountants, CPAs, we're busy. We're not doing a whole lot of tax planning then. This is a great time of year to start looking for an accountant because we don't have any deadlines coming up, really. So good record keeping, these are just some examples. You want to track your mileage, right? Don't go to your accountant and say, my mileage was the same as last year. No, it wasn't, buddy. Or it was 16,000 miles. Nobody has a flat number of miles. And these are just things that are usually flagged at an audit. I had a mileage audit a few years ago, and I was working with the auditor, and they said, well, he needs to go back and recreate his whole log. So he literally printed off a 12-month calendar and had to write down where he was going, what he was doing, and how many miles it was. So I use Mile IQ, but there's a lot of different apps out there tracking, for example, coming today. This would be deductible business mileage. Leaving, going back to your office, all deductible, as long as you keep track of it. I already mentioned bookkeeping. So when you're getting started out, I usually highly recommend getting some type of accounting software started. QuickBooks Online, Xero, which is Xero. Those are the two primary ones. There are some free ones out there, but don't be cheap. Just spend the money for your accounting software. Keeping receipts and invoices. This is a big one. You don't have to keep paper. In fact, I hate paper. Scan it, keep it electronic, keep it for 3 years, because you don't want to be in a situation where, the worst case scenario, you're being audited and you don't have that receipt because the ink on the Home Depot receipt faded. Credit card and bank statements are not sufficient documentation. Just keep that in mind. You want to have receipts. Make sure that you're keeping stuff separate from your business and personal. So I get it, when you're starting out a business, maybe you don't have a business bank account yet, or you don't have a business credit card, so you start funneling all these business expenses out of your personal account. That's okay when you're getting started, but you just want to make sure that you're keeping really good track of that, because that becomes your investment. That's your basis in that business. Where it becomes bad later on, after you create your LLC, is that's what we get into commingling. And I'm not an attorney, but if you are not acting like an LLC, you can't be treated like an LLC, right? So just keep it really clean. Also, repairs, I put the $2,500 threshold there, but most improvements if they're $2,500 or less, can be automatically deducted as opposed to capitalized. Gifts, this is kind of a silly one, and I can't believe that it hasn't been updated, but gifts are limited to $25 a person per year. So a good example I think about is realtors. They a lot of times have closing gifts, right? But those gifts are usually branded with their logo, and so that becomes kind of a marketing expense. It's not a gift expense. 1099s are a big one. Those are due January 31st of every year. You should be issuing 1099s to anyone that you pay more than $600 for services, for rent, and attorneys. I guess the IRS doesn't trust attorneys. But so when landlords, you always get 1099s at the end of the year, right? From your, if you have a management company, That's they're doing their duty of reporting the 1099s. Sometimes it's missed that, like me, for example, I rent an office. I send my landlord a 1099 for those rents. There are a lot of blurry lines, especially as we see people paying more and more with Cash App and PayPal and Venmo, all those things. Those third parties are responsible for sending the 1099s. So this is only if you are paying someone by check or ACH or cash. Don't do cash. Don't pay in cash. Business meals are 100% deductible, but that's only if you are out at a place for business. And here's a tip. I've had an audit where they were auditing the meals, and they wanted to know who you were with and what you talked about. So I always make a note on my meal receipts, at least who was there, and it was like team meeting or office, update, something like that. Going into audits, you really, when you can show right off the get-go that you are organized, that sets a completely different tone with auditors. They, like if you come in there and you're like, I've had people that like, well, I'm just gonna give them a shoebox of my stuff and let them have at it. That's taking the wrong approach. They're gonna, get off on that. There's a lot of tricks to save on taxes. These are loopholes, but again, it's being proactive instead of reactive. So I just put a couple up here, like paying your children. This is a really fun one, especially if you are a sole proprietor, like a Schedule C business, because you can pay your kids that are under the age of 18 up to the maximum, which is, it changes every year, but this year it's like $12,400. Your business can deduct that, and they don't have to pay taxes on that. They don't have to file a tax return because they're not subject to Social Security and Medicare. Then you could even take that money that you pay them and put it into a Roth for their investment, their future. They could use that for college, or they could use that to start a new business or buy their first house or something. What I will say is I do enjoy this strategy, and I do it for my daughter as well, but you just need to be cognizant of it, and it's always a substance over form. So does it make sense to pay your 2-year-old $12,000 a year? Probably not. I don't know. It depends on what they're doing, but if you're really young, Social Security will send you a letter. I got one last year saying, what did this person do? And you have to fill it out and give them the job description. So my daughter is 7, and we do a lot of direct mailing postcards, and she puts stamps and labels on them, and we send them out. And that's her job. Occasionally, it's not a lot of money, but every little bit helps when you are talking about taxes. So that's a fun strategy. It just has to be used carefully. If you have older kids, it's a really good one. Put them in the office, have them do shredding or filing, or I don't know, maybe people don't file anymore. But yeah, home office is also a big one. Make sure you're using that and doing that deduction correctly. If you have an S corporation, one that's fun is the Augusta loophole. It's called, well, that's informally, but it started with the golf tournament, the Masters in Augusta, where people were renting their homes out for the 2 weeks during that tournament, right? Well, the IRS said, well, you can rent out your personal home for up to 14 days and it's tax-free. So once that started, then people get creative. Okay, so now you can rent out your home. Your business pays you rent. You give yourself a 1099 because we're doing everything the right way, right? And you're getting that income tax-free. And it's an expense to your S corporation. It's not a distribution. One thing that I have successfully done this with some of my realtor clients is where they have parties for their brokerage or their team, and they're able to write off some of that rent expense. I'm going to touch on this one, but we're going to keep it high level, the real estate professional designation. So when you are in real estate, but it's not your primary job, maybe, let's say you have a W-2 income as well, your losses on that real estate income are capped. It's $25,000 loss capped if you are married. Let's say you're married joint and you have $150,000 of income. You can only take up to a loss of $25,000. Sometimes if you have more income than that, those losses are not, you're not able to take them. They're not gone forever, they're just suspended, unfortunately. So a lot of times we look at the real estate professional designation. Are you involved in a trade or business that's related to real estate? It could be maybe a builder or a realtor in construction. Those are related, but it's not actually renting out a home. Something like me, legal, that would not be a related trade or business, because if I'm not doing real estate, I'm still collecting income over here. It has to be 750 hours per year in real estate, and that is per property too. So if you are if real estate is not your primary job, and you're not able to take these losses, it might be something you want to look at and see, what your risk exposure is, but really track those hours of what you're doing working on that property. I want to touch on like-kind exchanges too, 1031 exchange. This is a great tool for deferring your gains on a property. So if you go to sell a property and you're going to buy a new property, usually you will have capital gains tax when you sell a property. An option is a 1031. So that's rolling that gain into a new property. That gain now becomes part of the basis of the new property. So the tax it doesn't go away, it's just deferred. Eventually, if you sell that property, whenever, you will pay tax because your gain will be much more. So this is why you have to think about what your long-term play is. Like maybe you are a legacy investor and you are just gonna have properties until you die. The nice thing about that is whoever gets your assets, they get a step up in basis. So that means their basis becomes the market value on day of death. And that's really, there's no tax there. They could sell that property and their value is the day right now. And that's a huge. But 1031s, there are some qualifiers there. You have to identify the property within 45 days. You have to close on it within 180. And your title company can figure all out the fun stuff there. The 45 and 180. It just has to be like kind, so it could be, a house for some land, or, an apartment for 5 houses, something like that. It just can't be a house for a jet. No, I'm sorry. Told you I was going to bring you down. No. Some of the things that you may encounter with your customers are maybe tax liens. We can work with people to get their taxes caught up, help to get a lien removed. It's not going to go away. It's just deferred. The IRS just wants to make sure that there's no one else in line to get any debt. And if selling a property would help pay off that debt, they would probably temporarily suspend that. So just a couple of things. The goal is to be able to close faster. So there's a lot of deductions in real estate. These are your buy and hold. And I want to just reiterate that don't ever think that you're deducting too much. Talk with your accountant. Let's be reasonable. But I would rather have a conversation and be creative than you do it. And then at tax time, I'm like, well, what is this? No, we're not doing that. But insurance, property management fees, anything that is ordinary and necessary to run that property is deductible. One time I had a banker tell somebody not to take depreciation, and I told them that that's not an option. You have to take depreciation. And so what that is, that's just a portion of your purchase price of the house spread out over 27 and a half years that you get to deduct. So it's not a cash expense, but it is helping to bring that taxable income down. You do have to recapture that depreciation when you sell it, but you can think about that then. Anyone read the book, 7 Habits of Highly Effective People? So habit number 2 is think with the end in mind, right? Just like starting a business. What's my goal here? Just like buying a property. What's my goal here? And, think about that. There's a lot of different ways to sell a property, and they can all be taxed, treated differently for tax purposes too. So seller financing, or CFD, also known as a land contract, that's when you're selling something on installment. So you are realizing that gain over a period of time. So let's say you do an installment for 30 years, and that gain was $100,000. Instead of taking that gain right now in year 1, if you sold it outright, you would spread it out over the life of the loan. So every year you are only recognizing interest income because you're charging interest and a portion of the gain. There are a lot of other nuances involved with CFDs. I'm sure some investors here could, elaborate on that. If they stop paying, you have to foreclose. So some people don't like dealing with that. An outright sale, like we've talked about earlier, of course, that's just your cost less the sales price and plus any depreciation. So I think it's good to have an accountant that you can talk to throughout the year saying, I'm thinking about selling this property, what would it look like? Or, maybe the tax isn't that much and it's not that big of a deal. Like, go ahead and sell it outright if you need the cash to do other projects. I had mentioned the 1031 and then the step-up in basis if you let family inherit it. Oh, questions? It seemed really fast. His question was, what's step-up in basis? So let's use a simple example. Let's say today you buy a property for $50,000, right? Well, property appreciates. And then let's say that you die 15 years from now and you let your family inherit that property. That property 15 years from now is maybe worth $75,000, right? So their basis is now $75,000, whereas your basis was $50,000. So it's step up. Yeah. Yes, ma'am? So her question was about scanning receipts. What's the best way to do that if you have a team of people that are all bringing in receipts? Systems. So you want to create a system, a policy of you put your receipt here every day from your jobs or whatever. And then you have somebody that's scanning that and uploading that to Receipt Bank or HubDoc or wherever your Google Drive is. But you create that policy in your system and you have to stick to it. Yes, ma'am? Yeah, so her question was paying your children, can it be converted to W-2? It has to be W-2. Yeah, so if you're gonna do this strategy of pay your kids, it's a W-2 salary. So if it's coming out of your S Corp, the business still will have to pay Social Security and Medicare taxes on that. If it's coming out of your C, like a sole proprietor or Schedule C, you don't have to pay the Social Security and Medicare, but you still have to issue W-2s at the end of the year. So it's not like it's not contractor payments. Right. Yes, sir? The day after Thanksgiving. Is it the wrong QR code? Okay, sorry. Yes, sir. Mm-hmm. Yeah. Okay, so his question was on cost segregation. At what point does it make sense for single-family homes? It's a good question. So keep in mind that cost segregations cost $3,000 to $6,000 from a company. So if that makes sense to you, and it could save you on depreciation, do it. Yeah. If you buy a house, again, going back to my $50,000, your accountant is going to take that less the land price, because we can't depreciate land, and spread it out over 27 and a half years. But if you can get a cost segregation done where they say electrical, foundation, blah, 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 and then say it's going to, save you X amount of depreciation, and if you need that expense, that's another one. If you need that expense in that year, do it. But you may not need that expense, and that's where it comes back down to knowing your numbers every single month. It certainly does make sense for large purchases like apartment buildings or fourplexes, but always keep in mind what is the end goal, because you always have to recapture that depreciation. Anything else? Oh, yes, sir. Commingling? Okay, so his question is on commingling, if it's illegal. I'm not an attorney. I would not say it's illegal, but it comes back to how would an auditor look at that, and if you were being sued, how would they look at that? You would say, well, this is my LLC. I'm running business out of my LLC, but substance over form, you're also running all these other personal expenses through there too. That doesn't look good. And so if you're going to operate as a separate business, you need to act as such. I highly recommend not commingling. If your business needs money from you personally, you take it out of your personal account and deposit it into your business account. Yes, right behind you. On the Augusta loophole, is there a limit to how much you can charge rent? It needs to be reasonable and fair market value. So if you were to look at places around here, for example, this event rent, what would they charge for rent? That's fair market value, right? Could you fit this number of people in your home and have an event? That would be fair market value. So it needs to be reasonable, yeah. Yes, ma'am. Yes, just 14 days a year. Yeah, are you going to keep it personally? Yes, so that just becomes your basis at the time of inheritance. Mm-hmm. Yeah. Well, if you just rent the house out, then you might want to have like an appraisal done of what that house is worth. Is my time? Yes, yeah. Okay, so her question is on home office and how do you do it right if you have an LLC. So there's two ways on the home office. There's either simplified method, which is $5 per square foot, up to like $500. Or you can do it based on all of your expenses to run your home, your personal home. So what I say is, if we want to take the non-simplified method, you need to keep track of your mortgage payments, your interest, your utilities, your if you have HOA, if you pay a guy, if you pay a house cleaner, all of those things, your cost to run your business, and then you're going to deduct a percentage of it based on square footage. But you need to keep track of that. Yeah. Yes, sir. To be able to write off the $2,500, it's kind of based on what it is. Now, if you are getting a project you're improving it to get it rent ready, that is generally something that needs to be capitalized, not expensed. But if you were to buy a refrigerator that was $2,500, you could deduct that as opposed to capitalize it. Hey, Drew. Staying in your vacation rentals, I would apply the same 14-day rule there.
Okay, what if you want it to be like a month out of the year? Is there a way that makes it work?
Like 30 days? I don't think so, but we could certainly talk about that and think about how to get creative legally.